Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm a market analyst for Equity Capital in London. And Equity Capital is a part of the overall equity group, which includes other organizations such as FX in Kenya and also Equity Nigeria in Nigeria. Now, for those of you who've not attended one of these Scan the Markets webinars before, the typical structure is that anything that I say or mention in the webinar should not be construed as investment advice. This is just purely my own thoughts and opinions. It's not trading ideas. It's not the house view of FX or Equity Nigeria. It's purely the thoughts and comments of myself, David Madden. Now, for those of you who've not attended before, the basic structure is I'll run through about 5 or 6 charts, talk about the macroeconomic news, talking about the technical analysis and also potential price points to both the upside and the downside. If you have any questions for me about the particular chart or topic I'm covering then and there, feel free to just ask a question on the live stream, or the kind of chat, or the question or comment section, and I'll get on to answering it. If the question is just something in general about the markets in general, I'm more than happy to answer that too. But I will leave that until the end of the after I've run through about 5 or 6 charts, and of course at the very end, after I've covered the last chart, I'll then be kind of throwing it open for saying any markets I haven't looked at that you want me to look at. So feel free to fire away there. And to be perfectly honest, I find these events normally go much better when there's more interaction. So please do not be shy. Feel free to kind of shout out saying what do you mean by that, or would you mind having a look at a particular chart. Now, getting into it, the first chart that I'm looking at is the gold market. There's a few things been going on in gold recently. Gold enjoyed a very impressive rally between late-ish March and mid-April, and it hit a 6-week high only a few days ago. Since then, we've had a retreat. Why was gold already rallying for so long? Well, gold has typically been a hedge against inflation. Inflation in the US is running high. It's at a 40-year high. Here in the UK, inflation is at a 30-year high, and it's at a record high in the Eurozone. And rising inflation is sadly a headline we're seeing across the board, across many countries around the world. And with that, people are thinking to themselves, essentially, if the money I have in my bank account is essentially dwindling in value, because if your pound or your US dollar, in theory, buys you less in 1 year from now than it does today, you need to be looking at potential options to where you can what you could do with your money. And historically, gold has been a popular hedge against inflation. Part of the reason why gold has had such an important rally recently. As I mentioned, gold has pulled back from its 6-week peak, and now we can see that it's been moving aggressively lower. We've fallen below all 3 simple moving averages here. In fact, the levels we've dropped to today have been back to levels last seen in early-ish April. So we're talking about a 10-day, 2-week low being set in gold, which says a lot. Why is this? Well, I know we've lost ground in global stock markets in the last few hours, but broadly speaking, in the last few days, we've seen a rally in stock markets, and traders are very much in risk-on attitude. What that means, risk-on, is essentially they're willing to take on more risk. And assets such as stocks and equities are deemed to be higher risk than assets such as gold, which are typically considered to be low risk. So in the last few days, we've seen multi-week highs being hit in a number of stock markets, which I'll cover in the next few charts. And it's no coincidence that when stock markets are rising, the likes of gold is falling. So look at the price action in gold. It's been moving lower in the shorter term trend for gold is lower. While gold continues to, if you look at the market indicator, it's in the red, it's in negative territory, indicating that the bears are in control. The RSI is moving lower here, suggesting the price bias is to the downside. If we do see a continuation of the short-term bearish move in gold, and it continues to hold below these 3 simple moving averages, just to let you know, I'm looking at a 4-hour chart here. All the charts I've been looking at are 4-hour charts. If we continue to move lower from here, and we continue to hold below all 3 of these moving averages, we could look to target 1929, and a break below that could see a target 1915. It is worth noting, though, that we did we enjoyed the more longer term trend is still to the upside. We had a rally here somewhere in the region of around 1890 up to just shy of 2000. So we rallied over $100 in this time frame, in this period here. We've dropped about $60 or $70 in this area here. You could now be at the point saying perhaps this upward trend is coming to an end. You could also make an argument that the longer term trend is still in effect. If you do see a rally in gold from here and we do manage to reclaim these 3 simple moving averages, that could be the beginning of the possibility of the kind of broader upward trend continuing. Should that be the case, we could look to target 1981, and a move beyond that could see a target 1998 rather. Another market of importance recently has been euro dollar. There's a couple of factors going on here. Firstly, any kind of currency pair that you look at, when you trade a currency pair, it's essentially it's the first currency you're buying or selling. If you're buying euro dollar, you're buying the euro versus the US dollar. If you are selling the euro dollar, you're selling the euro versus the US dollar. If we look at the price action of euro dollar, the longer term trend is enjoying a major move. It's at a major move to the downside. The levels we fell to back in last week were essentially almost 2-year lows. We're back to levels last seen basically about 2 years ago, or coming up on 2 years ago. Since then, we've had a bit of a rebound. What's been going on with euro dollar? I mentioned a moment ago how the last few days we've seen a broader risk-on attitude in the markets. To an extent recently, because of the fact that there's a war going on in Eastern Europe, in Ukraine, and because it's geographically and financially close to the likes of Germany and France, the Eurozone economies, there's been a kind of risk-on attitude in stock markets. And the risk-on attitude in stock markets has also kind of filtered through to the euro. So when fears were at their highest in relation to Russia, Ukraine, the euro was under major pressure. When those fears faded away a little and the sentiment improved, we saw a move higher in Europe. What we've also saw today, I know we've seen a lot of volatility in euro dollar today. What we also saw today was one of the members of the European Central Bank suggested the European Central Bank could actually hike interest rates in July. To be honest, I don't think that they will. I think he is very much out on his own in that. But the very fact that he said it just kind of acted as an upward move, give a lift to euro dollar. As you can see now, the market has kind of has given up a lot of those gains. What's also been going on the last few days, we've seen a broad sell-off in the US dollar. We saw the US dollar index, US dollar itself, hit a 2-year high on Tuesday, but then it ended up actually turning lower on Tuesday. We saw it decline yesterday, and it was in the red for much of today. In the last few hours, the dollar itself has turned around, but broad weakness in the dollar for the past 48 hours to 72 hours has also helped euro dollar move higher. It does appear to be turning over on itself once again. So looking at euro dollar here, while it continues to hold below these 2 simple moving averages, is the 50-period moving average and the 100-period moving average that I'm looking at. This other moving average here is a 20-period moving average. While it holds below the 100-period moving average and the 50-period moving average, it's likely the broader bearish trend will continue. Further losses from here could see a target of 1.0783, and a move below that could see a 6. Now, if you do happen to see a continuation of the short-term correction or rebound that's been in place here, where can we look to go to? Well, we could look to retest this zone here around 1.0988, and a break above that could see a target 1.1056. Looking here at the US 500, we can see in the last few hours, and the last few minutes, and last few hours really, we've seen a sharp move to the downside in the US 500. But prior to that, we saw the US 500 back up to levels last seen about 2 weeks ago. I mentioned a minute ago how we had general kind of risk-on sentiment in the markets where people are looking to take on more risk. With that, we have seen a decent rebound in the US 500. I can clearly see it actually continues to move lower as we speak. You know, even though we had an ongoing conflict in Ukraine, for the time being, we've had there's been no additional sanctions against Russia, and it's usually sanctions against Russia is what sort of actually rattles the financial markets. it seems to me that in relation to the war, when it comes to stock markets in Europe and the US, it seems to me that the actual day-to-day continued violence in Ukraine doesn't really impact the markets a huge amount. It's more to do with how Western governments will economically attack Russia in the form of sanctions and whatnot, or embargoes. That's the sort of issue that actually tends to actually impact the markets, because there's always the fears that what if Russia intentionally squeeze energy supplies to countries like Germany, who are very dependent on Russian energy. What's also been going on, we saw a rally for much of the first few days, for much of this week, even though we've seen higher interest. We've heard continued chatter about the possibility of higher interest rates in the US. The US have already raised interest rates in March. Next month, the markets, there's a lot of speculation. Not only are interest rates going to be hiked, they're going to be hiked by 50 basis points to 0.5%, rather than the usual size of 0.25%. This is given, it really kind of says a lot about the strength of the US 500, whereby it can actually continue to drive higher in the face of continued chatter about interest rates being increased at a fairly aggressive pace. Look at the price action in the last few hours. Prior to this very aggressive sell-off here, I would have said while we continue to hold above these 3 simple moving averages, it's likely the broader upward trend will continue. Given the fact that we've had a sharp move to the downside, this is a very bearish candle that we're seeing here. We've fallen back below all 3 simple moving averages. The sharp move lower in the relative strength index, the RSI. There's been a tapering off in the MACD indicator, so positive momentum is very much running on. The positive momentum is tapering off. The bulls are very much running out of steam. See the US 500 continue to hold below these 3 moving averages. It's likely the very recent bearish trend could continue. We could look to target 44.24, and then below that down towards the lows of last week around 43.60. Now, looking at the kind of a very short-term trend for US 500 is lower, but the more medium-term trend is higher. As we saw very impressive gains being racked up over the past few days. If we do see continuation of this rally, and we do manage to take out the highs of today, we could have to retest this peak here at 45.25, and a break above that could see a target 45.50. Looking here at the UK 100 in a similar fashion, has enjoyed a fairly impressive rebound in the last few weeks. It's been moving higher at a very aggressive pace, but has been moving higher at a fairly steady pace. Why is this? Well, the FTSE 100 has a disproportionately large amount of commodity stocks, oil and gas stocks, and mining stocks in its makeup. Now, even though by and large stock markets have fallen because of the war in Ukraine and rising inflation and prospect of higher interest rates, oil itself and metals have actually performed quite well in the last few months, because Russia is a major exporter of commodities. The fear is countries and companies might start doing less and less business with Russia, who buy minerals off them, oil and gas and metals. Therefore, we've seen an upward move in metals prices, an upward move in oil and gas prices, and therefore oil and gas stocks performed well, mining stocks performed well, and in turn the FTSE 100 did fairly well out of it as well. Also, energy providers, utility companies here in the UK have rallied as well. So we've broadly been moving higher. It's worth noting that the highs that we saw in the last 24 hours were at the highest level in about 10 days or 2 weeks. It didn't manage to retest the highs of early April, which is interesting in itself, but nonetheless, it's a very strong, it's a very kind of broad rally seen in the UK 100. While we continue to hold above this moving average here, the 100 period moving average, you follow it around, you can see it acted nicely as resistance here in early March. It acted as support here in mid-March. And notice, even when we had pullbacks in the UK 100 along here and here and here, it's never really even got as low as retesting that moving average. Buyers always seem to kind of step into the fold beforehand and turn the market around. So while we continue to hold above the 100 period moving average, it seems to be the broader upward trend will continue. Rallying from here, we could look to target 76.72, and a break beyond that could see a target 77.00. But we can't really ignore the fact that in the last 2 hours there's been an aggressive move to the downside. We've also seen an aggressive move to the downside in the US US 500. So if stock markets across the board are falling across the board, that could easily drag on the FTSE 100, the UK 100. Looking at the MACD indicator, we can see the momentum has now just entered the red. It's now just entered negative territory. So that suggests that the bears are now ever so slightly in control. The RSI is moving lower as well, indicating that price bias is to the downside. If you do see further losses in the near term on the UK 100, support could be found from this region here at 75.65, and a break below that could see a target 75.30. Coming on now to the JP 225, the Nikkei 225, the Japanese stock market. Similar fashion, I talked about how there's been a risk-on sentiment in the markets recently. There's been no additional sanctions on Russia for now. We've had a rally in the stock market the last few days, despite the fact, excuse me, we've had a rally in the stock market, in global stock markets, despite the fact there's consistent talk about higher rates coming in the US, higher rates already being announced in, say, New Zealand and the UK, and the chat, and even the kind of very faint chatter of higher rates from the Eurozone, which you don't really believe. But nonetheless, bond yields have been rising, and there's talk of higher interest rates. So it makes this rally all the more impressive. Earlier today, the Japanese market hit its highest level since early April. We're talking about a 2.5, nearly a 3-week high, which really kind of underlines how bullish the recent upward move has been. It's also worth noting, during this kind of period of risk-on sentiment, we've also had weakness in the Japanese yen. The Japanese yen, similar to gold, is often considered to be a lower risk asset. So whenever there's uncertainty in stock markets, the Japanese yen tends to rally. Vice versa, whenever stock markets are booming and people are willing to take on more risk and are very optimistic, the likes of Japanese yen tends to decline. So recently we've seen weakness in the Japanese yen, and guess what? For investors outside of Japan, a falling yen means it's relatively cheaper to buy Japanese stocks. If you're based in the US or the UK or the Eurozone or wherever it may be, or Australia, and you see a sharp decline in the Japanese yen, all of a sudden it becomes relatively cheaper to purchase Japanese stocks. So part of the reason why the Japanese market did extra well in the last few days is because of the weakness in the yen. Now you can clearly see here it's coming under selling pressure, like we saw on the UK 100, like we saw on the S&P 500. It seems to me stock markets across the board are falling, and the Japanese market is getting dragged lower by it. Even though it has been declining in the last few hours, it's still worth noting we're still holding above these 3 simple moving averages. So it's possible this sell-off might actually provide an opportunity to buy the dip. We can see here recently the market buying the dip in the last few days has proved to be a popular strategy. We can see here if it continues to hold above these 3 simple, possible the broader upward trend will continue. A rally from here could see a target 27,887, and a break above that could see a target 28,032. Looking here at the price action, this is a very bearish candle. Looking at the size of the body of this candle here, this red rectangle, it's very large, it's red, it's very bearish, indicating that the price is going lower. The RSI is moving sharply lower as well. You can see here that it essentially went from being ever so slightly close to overbought territory and moving lower, suggesting the price bias is to the downside, being a tapering off in positive momentum, indicating that the bulls have kind of run out of steam. If we do move lower from here, support could be found from this simple moving average here, the 100-period moving average. And as you can see, it acted as a resistance zone here in early April. In late-ish April, it acted as a support zone. So the possibility it could act as support again. That comes into play at 27,107. And a break below that could see us back down toward this zone here at 26,857. Coming on now, lastly, to US oil. If anyone have any questions for me so far, so feel free to just type in the chat box or the comment section. I'll happily answer those questions. If there are any markets I haven't covered so far, just feel free to shout out. I'll happily look at some markets. What's been going on with the oil market? So we obviously see here. I'm bringing the chart back here to late February, early March, at the kind of height of uncertainty surrounding the Russia-Ukraine war. There was concerns that there's going to be a massive shortage of oil. Russia is one of the largest exporters of oil in the world. Although there have been embargoes have been announced, things as bad as they weren't as bad as they thought they were going to be, if that makes sense. the price action in early March was expecting that almost everybody in the world who buys Russian oil would stop immediately. That would just be that. And there was fears that Russia would intentionally turn off the gas taps and the likes. Although some of that has happened in terms of embargoes, it hasn't been nearly as severe as feared in early March, and therefore the price has tapered off a fair bit. Although that being said, it's still comfortably above $100 a barrel for US oil WTI, so it is still at a fairly elevated level, and it's very sensitive to what's going on in relation to potential embargoes and potential sanctions on Russia. So what's been going on? We've had no additional sanctions on Russia for now. What's also been a factor in the last 24 hours, for the last few days, the World Bank downgraded its forecast for global growth, and we've also seen something similar with the IMF as well. So we're now at the kind of critical point where the global economy in late 2021, early 2022, showing signs of slowing down. There's been the kind of post-pandemic boom was already kind of running out of steam. To add to the mix, we've seen a sharp move higher in the cost of living in terms of CPI. Inflation figures have been moving higher and higher. We've already seen a number of central banks hike interest rates so far. There's talk of even more interest rate hikes. So essentially, businesses will pay higher, more interest on their loans. Individuals will be more interested on their credit card debt and the mortgages. And as the cost of borrowing gets higher and higher, it essentially dense profits takes money out of people's disposable incomes, and therefore it adds to the idea that there is less money, sloshing around the economy, because more and more funds get soaked up on higher interest rate payments. So the fact that we're heading into a period of higher interest rates at a time when there's a war going on and as a time of high inflation really does not bode well for demand levels. Because let's face it, if the economy starts to go down a gear or two, you'd imagine that it's quite possible that demand for oil will go down a gear or two. So we can see here we see oil fall this week. It has rebounded a bit in the last 24 hours. It's recouped about half of the ground that it lost earlier on this week. The more medium-term trend for oil is still higher, though. We're still trading above these three simple moving averages, or at least two of these simple moving averages. While we continue to hold above these moving averages, it's likely the more medium-term uptrend will continue. A rally from here, you could see it retest this peak here, 109.09. Going beyond that, looking towards $110 a barrel. And if you break beyond that, then we're looking up toward this peak here around $113.21. Looking at the more shorter term move has been to the downside. If we do break below these three simple moving averages, we could look to retest this area here at 99.53, and a break below that could see a target at 96.74. That's basically all the kind of charts I actually was kind of planning on running through for this update, for this scan of the markets. If you have any questions for me at all, feel free to just fire away. I was just wondering whether it be questions along the lines of explain something that I've already gone through. Are there any markets that I haven't covered that you'd like me to take a look at? So if you want to shout out, feel free to kind of fire away and say, oh, would you look at whatever it might be it the Dow Jones, or the Dow Jones, or silver, or whatever it is. I'll just wait a minute here, another minute or so, and if there's no further questions, if there's no questions at all, I'll look to wrap things up in the next 34 minutes. Now is your chance to ask, and I'll happily answer them. Well, seeing as that we actually haven't had any questions at all for this update, no worries. That's perfectly fine. I'll look to wrap things up there. Thank you for those who tuned in live. Before you do go, I just want to quickly say to you, anybody that is on Twitter, feel free to tweet me. Follow me on Twitter. Feel free to tweet me. Ask any questions you want. My Twitter handle is @dmadden_equity. You can see, obviously, for those of you who are clients of FXPayza, there's an FXPayza account here as well, at FXPayza KE. So I will look to, I believe there could be a question coming in here. I'll just hang on for 1 second. But anyone who is on Twitter, feel free to give me to follow me. Feel free to ask me any questions. Now, to be fair, as I said at the very beginning of this webinar, I can't give advice. I can't, make buy recommendations. Nothing else I say said this webinar should be construed as trading ideas or investment advice. It's just purely my own thoughts, my own opinions. So I got a question coming in here that now. What's your view on the DXY the dollar index? Another question here: which stocks would you recommend buying first? I can't offer advice. That will be explicit. That is a very loaded question. I really can't offer advice. If there's any stocks you want me to take a look at and say, would you, or any markets you want to take a look at, after you've bought a comment, but I can't be coming in for compliance reasons and start saying I think you should buy this. In relation to the DXY, we don't, unfortunately, we don't actually offer the dollar index as a product to trade on our platform. I wish we did, but we don't. But what I'll do is, the next best thing is I'll look at a number of dollar crosses. So the DXY, for those of you that don't know, the dollar index is essentially, it's essentially in a similar position to how a stock market is composed, in a similar fashion to how a stock market index is composed. It's done on a weighted basis. So I know for a fact that the euro has about a 50% weighting in the US dollar. So it's almost like taking 50% of euro dollar, 10% of pound dollar, 10% of dollar yen, 10% of Aussie dollar, and 10% of Swiss dollar, and amalgamate what's going on with the US dollar, because obviously the US dollar is in a currency, is in multiple currency pairs. But when someone asks you today, how's the dollar doing? You have to go through, well, euro dollar is doing this, pound dollar is doing that, dollar Swiss is doing this, dollar yen is doing this, all this sort of stuff. So I'll talk about it in broad strokes, starting off with the euro dollar. So if there is, euro dollar is I'll start off by saying euro dollar is not an inverse of the dollar index. It's not too far away from it, because there's actually a lot of euro dollar goes into the dollar index. So this is probably the kind of closest, but it's far from an inverse of the US dollar. So euro dollar here, I can see here the broader picture. It's been a very aggressive move to the downside. A lower low here, a lower high, a lower low. The lows have fell to here, not that only a week or 10 days ago, were levels that were seen basically 2 years ago, either 2 years ago or not too far away from 2 years ago. So the really big picture view for euro dollar is to the downside. Sure, we've had a fairly aggressive move to the upside here. We cleared these, we kind of traded close to these peaks here. We saw 1, 2, 3. We noticed how we didn't even actually retest the highest of these peaks before we moved lower again. That in itself is quite telling. I would suggest that the broader, because the broader trend for euro dollar is to the downside. The flip side of that is the broader trend for the dollar itself, the DXY, is to the upside. So I think we're going to continue to see a bullish run in the US dollar. Therefore, I think we're going to see in the more medium term a continuation of the broader downward trend in euro dollar. Also looking at other dollar crosses. Take a look at pound dollar now. A simple look at pound dollar would be similar situation. This here is a pound dollar, a clear downward trend in pound dollar. We can see here that the levels we fell to, I know it's a terrible looking chart, that's why I didn't bring it up. The levels we fell to were back to August 2020, not long ago, on pound dollar. So once again, we're talking back to levels. You're talking about 18-month, what's that? Thereabouts, a 20-month low on pound dollar. So once again, euro dollar fell to a 2-year low. Pound dollar has fell to a level last seen. In August 2020. So we're getting a picture here of how weak how weak the currency pair is. I'll take a quick look at dollar yen, because I know dollar yen has been booming recently, and also the pullback the last few days. But dollar yen recently rallied to 2015, so dollar yen is very, very strong. Look at that. It's now a daily chart. Dollar yen is booming. So put all the pieces of the puzzle together. Euro dollar recently fell to a 2-year low. Pound dollar recently fell to a 20-month low, and very recently dollar yen rose to a 7-year high. So the broad kind of common denominator there is that the US dollar is very, very strong. We could, we see it turned around in the dollar in the last few hours. This could be the beginning of the next leg higher. So if you're trading dollar yen, the lows that we saw here in dollar yen, this could be the beginning of dollar yen turning around. Once again, buying the dip has been a popular strategy in dollar yen recently. We had a rally to a peak here. We had a very large pullback. The market started to move higher again. We've had a bit of a pullback here. It turned higher. A bit of a pullback here. The market turned higher. We've had a larger than usual pullback here, and we appear to be turning higher. So it seems to me that flex of broadly speaking, the dollar appears to be getting higher across the board. I have an individual here asking me about I joined late. Talk about gold gladly. That's on the same topic. If you trade gold, you must keep an eye on what's going on with the US dollar. Gold, like other commodities, is listed in US dollars. When the dollar is strong, it typically puts downward pressure on gold. When the dollar is weak, it typically uplifts gold. You also need to be keeping an eye on what's going on with global stock markets. I know you joined late, but I'm going to reiterate what I said earlier on. For the last few days, between say Monday up until a few hours ago, stock markets around the world were moving higher. Traders were very optimistic. They were very bullish. They were in risk-on mode. They're happy to buy riskier assets. So with that, we saw a bit of weakness in the gold market. Why? Because when people are very optimistic, they tend to sell gold. When people are pessimistic, they tend to buy gold. So even if you don't trade stock markets or trade the US dollar or dollar crosses, if you trade gold, you need to be paying attention to what's going on in stock markets. You need to be paying attention to what's going on with the US dollar. Gold, the more medium-term trend for gold, in my opinion, is still higher. It's, granted, we've lost about $55 from the recent peak, but keep in mind, prior to that, we enjoyed a rally of over $100 in this period here. So the broader upward trend is still in effect, as far as I'm concerned, with gold. I'll become more confident in that view if gold were to retake these 3 moving averages. There's a 20-period moving average, a 50-period moving average, and a 100-period moving average. If you reclaim these moving averages here, I'll then be even more confident that the medium-term uptrend will continue. If we do rally from here, we could have the target 1981, and a break beyond that could see, and then if you go beyond that, 2000, and then looking up towards 2021, and then the recent high was around 2070. That being said, we can't ignore the fact that we've recently fallen to a 1-week low, or 10-day low in gold. It's below all 3 moving averages. If it continues to hold below those moving averages, we could see the market move lower from here. Moving to the downside, we could look to target 1929, and a break below that could see us back down towards 1915. The Dow Jones, kind of a chart to thank you, David, for your insight on the DXY. No problem. Happy to help. The Dow Jones. I'll take a look at the Dow Jones now, and if there are no other questions, I'll then look to wrap things up, because we're now coming up. We're now going on to kind of a 40-minute webinar so far. The Dow Jones, I'm pretty sure. US 30. Here we go. Okay, so obviously some of these prices are. I'll move the chart. These prices. Let's see. High 495. So we've enjoyed a pretty impressive rally on the Dow Jones, the DS30. We can see here, this is here, the first week of March here. So we're talking over 1 month. We've enjoyed a very impressive rally. We moved all the way higher here. We found, if you look at it in various kind of, you could look at it in one kind of, fall, one massive kind of swoop and say, the market essentially did this. It's not a, this is far from a perfect trend line, but you get the broad picture. What's going on here? Broadly still the market rally for the last 5 weeks, and you could actually break it down into. This is what I like to do. You can almost break it down into a couple of moves all in one go. So you can go this one move here. And then lastly, so you can view this as, I'll get rid of this chart now. You can view this is the higher high, the higher low, the higher high, because they're always trending from the 8th of March up until 30th of March. We, broadly speaking, enjoyed a major upward move in the US 30. Then we saw a contra move because the market will give back some of the ground that lost, and then it moved higher yet again. And the highs that we posted in the last few hours here have exceeded these levels here. So we're back up to level. It's only a while ago. We basically rallied to levels last seen a few hours ago. We rallied to levels last seen only in early February. So we're talking like multi-week highs being set on the Dow Jones. So that really kind of, for me, to my mind, speaks to how bullish the market is. We've had a rally that brought us up to a level last seen in the 9th or so, or the 9th of February. So we're talking back 10-week high basically being set, a 9-10-week high being set. So if every now and again you are going to have a bit of a pullback. We're seeing stock markets across the board fall. Every now and again you see a bit of a pullback. The response is, what do you do next? Do you use that as an opportunity to buy the dip? Do you wait in the sidelines to see what happens, or do you think, oh wait, sentiment's turning around? To my mind, stock markets in the kind of more medium and longer term have been moving higher. As you can see here on the way up, buying the dip is clearly a popular strategy. We did see a bit of a pullback here, but notice how the lows that we set here we're not too far away from the kind of the peak that was set here on the way up. And it didn't actually, in the grand scheme of things, it didn't actually last very long. And all of a sudden, we rebounded to a new kind of 9-10 week high recently. While we hold above these three simple moving averages, I think the more medium term and longer term uptrend is going to continue. Rallying higher from here, I think we could retest the recent highs of around 35,500, go beyond that, and then we're looking up towards 36,000 with the next big level to watch out for to the upside on the US 30. We then actually in the interim we probably end up going toward this peak here around 35,875, and then beyond that up towards 36,000. Now that being said, we are seeing a sharp move lower in the RSI, indicating the price bias is in the downside. There's been a clear tapering off in positive momentum on the MACD indicator. So once again, that suggests the price bias is to the downside. If we do lose further ground from here, we could fall back down towards this moving average here, the 100-period moving average, in around 34,000. Well, first and foremost, 35,000, big psychological number to watch out for. And then below that, potentially back down as low as 34,666. And then if you break below that, we can then head back down toward this zone here around 34,326. Because I've been talking now for over 40 minutes. As for all those who stayed at the end, I do appreciate your time, and I really appreciate as well the questions. I really do, because it makes the overall event better for me. It makes it better for you. Otherwise, I often just kind of feel like I'm just talking at a camera, and that's just that. I hope you found what I covered in today's webinar useful. If you're chatting to any of my colleagues and any of your account managers at FXPesa in Kenya or in Nigeria, feel free to kind of pass on any thoughts or comments you have in relation to how we can improve these webinars. As I mentioned just before I go, once again, I'll talk about, I'm on Twitter at @DMadden_equity is my Twitter handle. Feel free to tweet me. I obviously can't give you any advice, but I'll try and give you as I'm going to give you my honest opinion in the most compliance-friendly manner as possible. So I'll look to wrap things up there. I'll be back on again this time next week, so feel free to sign in then. And if I don't speak to you between now and then, everyone have a good week and have a good evening. Bye, everyone.